welcome to Husslefreewealth. This is your perfect asset allocation. I'm sure you guys would have heard this a lot on social media, but is there an asset allocation that is perfect for everyone? I analyzed 25 years of data of various asset classes and we'll see if there is an asset allocation that is perfect for you. Stop copying others and decide based on data which one is best for you. What we are going to cover in this video is that I'm going to share point-to-point returns of various asset classes over the last 20 years. Then we'll also look at 5 years and 7 years rolling returns for the past 25 years. And then the portfolio mix that gives maximum returns and the one which has lowest and maximum drawdown. I'm also going to talk about the issues with managing asset allocation. And I'm sure every serious investor would have faced some of these issues, if not all. And then I'm going to talk about a framework that can help you decide your own asset allocation. Now let's look at the performance of each asset class in the past 20 years. So clearly, gold has been the best performer here, delivering 15.1% returns over past 20 years. However, when it comes to consistency, US equities stand out. Look at the returns given in 1, 3, 5, 10, 15, 20 years. It has been fairly consistent. But when you go back another 5 years to 20-year returns, if you look at the 20-year returns, the returns reduced by 5%. So that is a lot. And same is the case with gold. So returns drop drastically when we look at the 15-year period, the one highlighted in red, 12.6%. It is also worth noting that gold's impressive performance is largely driven by its recent run-up rather than steady gains across 2 decades. But do not neglect the drawdown in each asset class. Look at the drawdown for Indian equities minus 55%, US equities minus 45%, then gold minus 35%. And I'm not sure if most of the investors will be able to stomach this kind of drawdown. Okay, now let's look at portfolio mix. Remember, the portfolios were rebalanced annually whenever allocations deviated by plus minus 5% or more. I don't like to evaluate, point-to-point returns, but then many people want to see this. So that is why I included this in my presentation. So what you'll see is, if you add gold to the portfolio, the returns increase by 2 percentage points. And remember, this increase is also partly driven by gold's recent run-up. Now let's look at these individually. If you have 70-30 equity debt ratio, then over a period of 5, 7, 10, 15, 20 years, your returns were 15, 13, 12, 10, and 13%. And if you went with a little bit balanced approach with the same allocation in equity and debt, then your returns were 13, 11, 11, 10, 12%. So around 11, 12% is what you get when you have equity and debt as 50-50. Equity 30 and debt 70%, then your returns range between 9 to 10%, as that is evident by the data. Now, what happens if you add gold to the portfolio? So if you see, look at this one, 70, 15, 15. 70% is equity, debt is 15%, and gold is 15%. And if you compare it with 70-30 equity debt, your returns increase by 2 percentage points. So in a 5-year period, 70-30 equity debt gave 15%, and 17-15-15 gave 17%. Same is the case when it comes to 7-year period. In 10-year period, in fact, the returns have been 3 percentage points higher. And in 15 and 20 years period also, the returns are 2 percentage points more. So basically that shows that if you add gold to the portfolio, your return increase by somewhere around 2%. So what happens if I have 50% in equities, 25% in gold, and 25% in debt? The returns are quite similar to 70, 15, 15. The returns are almost same, barring the 10-year period and the 20-year period. In that period, returns were a little lesser. But then the portfolio drawdown would have also been lesser. One of the interesting thing to note here is these two portfolios right at the bottom, 50, 25, 25 and 30, 35, 35. 50% in gold, 25% in debt, 25% in gold, and then 30% in equity, 35% in gold, and 35% in debt. Both of them significantly beat the 70% equity and 30% debt portfolio. You look at the returns across 1 year, 3 year, 5 year, 7 year, 10 year, 15 year, 20 year period. So they are beating 70-30 equity debt portfolio. And this is my favorite slide, rolling returns, because it tells us about the consistency of the portfolio, and it is more realistic than point-to-point returns. And again, remember that annual rebalancing was done whenever portfolio deviated by plus minus 5% or more. So let's look at the average returns first. So average return for 70-30 portfolio, 5 year average return is 14.5% and 7 year is 13.9%. For equity debt 50-50, the 5 year return is 13 and 12.6%. Equity 30 and debt 70, the 5 year and 7 year returns are 10.9, 10.8, hardly any difference. Now, what happens when we add gold to the portfolio? So if you add 15% gold instead of 30% debt, if the portfolio has 15% gold, the average returns increase by 1.2% in when it comes to 5 year average rolling returns. And when you look at the 7 year, almost similar, around 1.2%, but with similar drawdowns. Now let's look at what happens if your equity portfolio is 50% and debt is 25% and gold is 25%. Returns, average returns are similar to 70% equity, 30% debt. The drawdown reduces significantly. So in 70-30, the drawdown is minus 36%. In 50-25-25, the drawdown is minus 21%. I feel minus 21% is still manageable. Minus 36 is difficult for plenty of people. So minus 35 is for equity 70, debt 15, gold 15, but the returns are superior. Now it depends on you as to which one you want to go for. If equity is 30, debt is 35, gold is 35, then the drawdown reduces significantly to minus 8%, but then you compromise on the returns as well. But please remember that having 35% gold in the portfolio is not easy. It is very difficult to rebalance. Now let's look at the consistency of returns. So what percentage of times the portfolio gave returns greater than 10%? So clearly 70% equity, debt 15%, and gold 15% is the winner here, with 85% in 5 year rolling returns and 91% in 7 year rolling returns. When you look at equity 50%, debt 25%, gold 25%, 77% of the times it has given 10% or more returns in 5 year rolling period, 80% of the time in 7 year rolling period. I don't think that is bad. With 30, 35, 35, 74% and 71%. Do keep an eye on the maximum drawdown. Many investors have joined in the last 4 or 5 years, and they feel that they can stomach volatility. It is not easy. This is the same chart that we discussed previously. Have just added the slide here in case anybody wants to analyze or take screenshot of the data to decide their own asset allocation. Now let's look at the key takeaways from the data that we just analyzed. 70, 15 clearly emerged as a leader, offering both strong average returns and the highest consistency of 10% or more returns. And what we realized was that adding gold significantly boosted returns compared to pure equity debt portfolios with similar maximum drawdowns. And what we also saw is that adding gold to the portfolio kind of lowered the maximum drawdowns. When it comes to investor profile matching, for aggressive investors, 70, 15, 15 is the way to go based on data. But remember, the drawdowns were significant. And if you don't want to add gold in the portfolio, in that case, 70-30 gave better returns. For moderate investors, 50, 25, 25 provided a balanced approach, because when we looked at the data, the drawdown was minus 21%. I think minus 20% is something that one can manage. But again, it depends on the experience, etc. And for conservative investors, the data tells us that 30, 35, 35 is best, but I don't think many investors would be able to handle or manage 35% gold in their portfolio. So for them, 30-70 works well. Okay, so your personal asset allocation framework. So data shows what worked historically, but your asset allocation must fit your life and profile. So do consider these 5 critical factors whenever you're deciding your portfolio mix. So the first thing that we need to look at is the risk temperament. Can you handle minus 20%, minus 40%? your tolerance matters more than theoretical returns. So it is easy when it looks on paper, but it is very difficult when you're actually going through it. Okay, second is life stage. If you are early in your career, most likely you will have high debt allocation. And contrary to what you hear on social media, don't go overboard on equity. You will be able to recover from bad decisions, but you will take bad decisions if you don't have experience and knowledge of market cycles. So start slow, learn, and then decide the asset allocation that is suitable for you. Next is job stability. I don't have to speak much on this. Fragile jobs need safer allocation. I'm sure everyone can understand why. Next is family dependency. If you are the sole breadwinner or you have a lot of dependents, uh, clearly you should be taking lower risk. Now, here is where you can take slightly higher risk. If you have strong family financial support, that can allow you to take higher risk. Lack of backup requires conservative positioning. And there is one more thing that I did not mention here, but knowledge of market cycles and how different asset classes behave, that is also critical when it comes to deciding your portfolio mix. Copying the experts. Please understand that influencers showcase their allocation or their idea of perfect asset allocation, not yours. The reason why I made this video is because I saw a reel from a popular influencer who said 60% equity, X amount of crypto, Y amount of gold, etc. So the only issue that I have with that reel is that some of the folks who are inexperienced or don't have the temperament to handle drawdowns, they'll start following this popular influencers asset allocation, and it could turn catastrophic for them. Now, I'm not saying what the influencer said was right or wrong. That's a different debate altogether. So do not copy and follow others when it comes to asset allocation. Don't follow, the asset allocation that I have. My own asset allocation changed a lot since I started my financial freedom journey. The asset allocation, that I had when I started versus the asset allocation that I had when I achieved financial independence. So there is a huge difference. It is again going to change, once I quit working. And also remember that wealth experience and risk behavior, they differ from person to person. And remember that beginners emotionally cannot handle 70 to 80% equities. I've seen multiple videos wherein folks have said you should have 80% equity, 100% equity. But please understand, theoretically that is correct, but practically that is not. Why? Because if this person who has 100% or 80% equity, and if the market falls down by 20%, this person will probably liquidate their investments. So it depends on plenty of factors. Now, next is behavioral traps that destroy asset allocation. And I'm sure many of you would have faced, these issues. So first is tax fear. So I don't want to rebalance because if I do that, I'll have to pay 12.5% tax, capital gain tax. That is one reason. Next is market timing paralysis. There are times when your asset allocation tells you to sell equities, but then equity market is down. People don't sell. Next is long-term versus short-term tax trap. So let me wait for the asset to qualify for long-term capital gains treatment. Many times investors would have already exhausted the 1.25 lakh LTCG exemption limit. So they wait for the next financial year to rebalance. So next is asset class issue trap. Gold crossed my threshold allocation. Should I wait until my gold bond matures before selling? Because many of the investors, they bought SGBs. Next is monthly investment mismatch versus desired allocation. The investments that people do and the asset allocation that they have is different. If you want me to make a video on how I handle these issues, please drop in the comments. Remember this, the best allocation is one you won't abandon in bad years. The asset allocation keeps on changing. It keeps on changing based on your knowledge of the market, your financial circumstances, your family situation. What works at 25 won't work at 55. So do not copy someone else's asset allocation. Decide an asset allocation, what is good for you. We have already looked at the data. And if there is anything else that you want me to cover, please drop in the comments and I'll be making a separate video on that. And if you like the video, please like, share, and subscribe. And if you have any questions, please drop them in the comments. I respond to almost every comment that is there on the video. And disclaimer, I'm not a SEBI registered financial advisor. The content on this channel is for educational purpose only and should not be considered as financial advice. Please consult your financial advisor before making any investment decisions. Thank you. Have a blessed day.